Greetings. My name is Dan Smith, and I'm with Compliance Ease, part of Citus AMC. Good morning and good afternoon, depending on where you live, and good evening if you're in Burkina Faso. This webinar series has a large following in Burkina Faso. You're about to listen to what promises to be an engaging conversation between Melissa Richards, who is of counsel at Buchalter, and Stan Middleman, who is CEO at Freedom Mortgage. In just a moment, we will dive right into content, but first, let's take a moment and talk about a few housekeeping items. This webinar is 1 hour, and we encourage you, the listener, to submit questions at any time using the GoToWebinar question box in the upper right-hand corner of your screen. Melissa will try to incorporate many of them towards the latter part of this discussion, time permitting. Second, this discussion will be available at a later date. In fact, our first webinar with Chrissy Johnson, Jed Make, and Ed Pinto about mortgage lending post-COVID is now available on the Compliance Ease website. So this is our second risk and compliance webinar, and the first since we've become a part of Citus AMC. Additionally, please mark your calendars for December 9, when we will have our third webinar with Nancy Weisgold, and she will be interviewing Jeremy Wyndham, chair of the Multi-State Mortgage Committee. I would also like to mention for our listeners that we have our new CCP, or Certified Compliance Professional Designation program, and to please reach out to me if you have interest in this program. Also, if we have a sister program, the Certified Legal Professional Designation, which is an excellent segue to our moderator, Melissa Richards. And we could not have asked for a better duo to join us today. And to be respectful of time, I will turn things over now to Melissa, ACLP, to introduce herself, as well as Stan Middleman. Thank you both so much. And Melissa, the floor is yours.
Thank you, Dan, and thank you, Compliance Ease, again for hosting this webinar. I'm Melissa Richards. I'm with the Buchalter Law Firm in San Francisco. I have spent the last 30 years as a legal advisor to the mortgage banking industry. As Dan mentioned, I'm a certified legal partner with Compliance Ease, and I'm a certified mortgage banker with the National MBA. I'm joined today by Stan Middleman. Stan is founder and CEO of Freedom Mortgage, which he started in 1990, the same year I entered in private practice. Stan is also an MBA board member. He's member of the Housing Policy Executive Council and affiliate of Financial Services Roundtable. And Stan's past service has included a member of advisory boards of Fannie Mae and Freddie Mac and the MBA Residential Board of Governors. Freedom Mortgage has had an incredible 2020. As Inside Mortgage Finance has reported in the last month, Freedom Mortgage is ranked #1 in VA, Ginnie Mae, and FHA lending for the first half of 2020. In August, Freedom surpassed a $14 billion origination month, bolstered by a loan servicing portfolio of over $300 billion in assets. And did I mention that Freedom Mortgage has been in business for over 30 years? 30 years is the anniversary this year. It's been an incredible run, Stan, and quite a tribute to you and your leadership team. Now I'm going to start my questions with the beginning, the opener, and that is your why. Why did you get into the mortgage banking industry, and why did you start Freedom Mortgage in 1990 at a time when depository institutions pretty much dominated the mortgage banking market?
I needed a job, so I had to go to work, and this seemed like a pretty good idea. For a number of years prior to being in the mortgage business, I was selling insurance and investments, primarily annuities. And as interest rates started to come down, I really viewed mortgage lending as a reciprocal relationship to investing from the consumer's standpoint. And if there was a waning interest in annuity sales, there's probably a rising interest in borrowing money. And fortunately, my timing was pretty good. I entered the market at the beginning of the greatest bull run of probably any industry ever, and I've been very lucky to be in the right place at the right time, bringing the appropriate skill set and experiences, and accumulated some more. So things kind of worked out for me. And if you work hard and you're well-timed, a little lucky, and you pay attention and you're sensitive, you have a chance to be successful.
So true, Stan. How did the company harness innovation to successfully transition the market changes over the course of the 30 years? You talk about the bull run in the 90s and in the mid 2000s, and then we ran into Great Recession. And then we ran into, 2010s with all the regulatory restructuring, new primary federal regulator, and into in 2020 with COVID and this great refinance loan production run. But in its essence, what would you say was what was your strategy and your goals for harnessing innovation to get through the ups and downs of this very cyclical market?
So I don't know that it's just innovation in terms of tools. Tools are nice, and I think it's important to have tools. But sometimes it's innovation in terms of process. When I entered the business very long ago, files were very thick. They were very manual. There was a lot of mail. By the 90s, we actually saw a lot of overnight mail. So I think of tools and technology. It reminds me of when we used typewriters to do verifications. And a big advancement was a single line of memory in that typewriter. It was the greatest thing since Correctatype. And I think about the technologies that we used, things like a fax machine. So I bought my first fax machine, and I had to buy a second one. So I had somebody to fax things too. Over the years, we've seen a lot of changes in technology, and we've been able to incorporate that. But you have to really think about your business in terms of process. And it's about thinking about manufacturing and cost control and managing your business to the moment and taking advantage of the tools that are available to you at the time. And those tools always change. They have always changed. They always will change. They're just changing a little faster now. And I think that the opportunities that we're enjoying today is the results of 30 years of iterative practice adjustment, right? So, you'll often hear people talk of iterations when they talk about technology. And I think that the entire mortgage process has been one series of iterative moves after another. And I think that really holds true today. We're just able to take bigger leaps faster because we're standing on the shoulders of the things that we've done before. And I really do think we're standing on the shoulders of giants. So many people have done so many amazing things through the years that we're able to deploy today to make us better.
So true. Absolutely, Stan. Thank you. Next, I want to turn to and give you proper accolades here to the Great Recession. So Freedom Mortgage was one of the few independent mortgage bankers that survived the Great Recession and thrived after. My question is, how did you position the company for survival and growth during those turbulent years? And here I want you to also speak to you've got impeccable timing, I think, in your acquisitions and your merger activity, and we'll get to more of that in the 2019-2020 cycle. But you did a key acquisition ahead of Great Recession. So can you talk about that time period and how Freedom Mortgage made it through intact and stronger after?
Well, I heard that the meek will inherit the earth. So there was no one more qualified than we to survive that event, because we were pretty small heading in there. And I think when we acquired Irwin Mortgage in 2006, and the reason that we did that was so that we could become skilled in Ginnie Mae products, FHA and VA in particular. We knew that they were going to be important products in the future, and they hadn't been very important for the preceding several years. They only had government lending only consisted of about 2% of the entire market at the time that we did the transaction. Irwin Mortgage was already a top 10 Ginnie issuer at the time of acquisition, and we really wanted to be in that business. One of the things that we always tried to do from the time I started the business all the way through today is to really focus on the underserved. We didn't have a built-in market. So many people had relationships, and the mortgage business was really driven through relationship lending, going way back into the 90s and the 2000s and even in the 80s. And even to a certain extent today, where real estate brokers had relationships with mortgage brokers. And we really didn't have those relationships when we built our business. So we were looking for other ways to market our products. And what we tried to do is think about the consumer. So we tried to build out niches in the underserved community with the vet, trying to help people reduce the term of their mortgage or get cash out, or do different things than the relationship sales created. That experience really led us to understand the value of government lending and how important that was to the consumer. And we really took up that mantle and focused in on that. And again, whether it was being in the right place at the right time, being lucky, when I'm right, I'm a visionary. When I'm wrong, I'm whimsical. But, in this particular case, we looked out and thought that there were some opportunities to really focus in on that. I was also very concerned by that time about property values. I was concerned about private mortgage insurance companies. And I was concerned about the repurchase responsibility through Fannie Mae and Freddie Mac based on appraisals and on private mortgage insurance. I didn't know I was going to become quite the expert at it that I did become, unfortunately, but I think that we had enough of an idea to try and move away from that. So what we tried to do was position ourselves more to the underserved and to government lending, and that kind of got us out of the cauldron, so to speak, of what became a big problem in the GSEs and in conforming loans.
Yeah, indeed. Continuing on our conversation topic of acquisitions and mergers, in the last year, 2019 to 2020, Freedom Mortgage has experienced tremendous growth in that M&A area. In August 2019, Freedom acquired J.G. Wentworth Home Lending, opening up new markets, adding $6 billion in servicing, 570 additional employees, and 35 additional offices nationwide. And then in August 2020, Freedom finalized a merger with RoundPoint, which is now a wholly owned subsidiary. It's raised your servicing rights portfolio to around $310 billion. Wow, what a year. COVID didn't stop you or Freedom. How is Freedom managing this tremendous growth while maintaining corporate culture and the company's culture of compliance?
Well, so the key is, and we kind of expected what was going to happen. Our business is last I checked, interest rate sensitive. And that interest rate sensitivity had been testing our industry throughout 2018. Interest rates had risen a bit, volumes had come down to their lowest levels in some time. There were a lot of mortgage companies struggling. So we were buying companies that were having potential difficulties coming into or out of 2018. So our timing was good. We had agreed to those deals prior to interest rates coming down. Now, we had expected interest rates to come down. Unemployment was already at an all-time low. So there was a tremendous amount of employment in the country. The economy was great. So when things go like that, the next logical step is for it not to. So we didn't know there was going to be a pandemic, and we didn't expect the depth of the seriousness of the issues that we have faced. And God knows we faced more issues than any of us had hoped for. But we did expect that there was some dry kindling there that would lead to higher unemployment. We didn't expect the economy to remain as strong. And we also understood that this is one of those points in the cycle where the perfect storm was about to occur. There wasn't a lot of new houses built. There wasn't a lot of excess inventory. The amount of housing that had been added over the last decade had been pretty low. So we knew that the value of homes were going to rise too, and that the credit of the collateral that we were financing was going to get better. So we felt really good about the credit environment that we were coming into. We felt really good about the quality of the credit of the portfolios we were acquiring. And we knew that we were going to be really busy. So we added a lot of servicing personnel with the ability and the experience to service loans. We added a lot of origination personnel. The servicing personnel came in Round Point. The origination personnel came in Wentworth. And you might even suspect that we did this on purpose. As it came online, we've been able to really make both of those organizations, already Wentworth and Round Point on the way to being very effective. We're going to need the skill and the expertise of the folks that we've added from Round Point to help us with the path to cure for all the customers that we've acquired, and to onboard the additional originations that we're creating. We're running almost $15 billion a month in new originations. And with that level of activity, and I think more to come, because I don't think we've seen the lowest interest rates yet, that type of activity is going to require us to have a little bit more girth, a little more strength. And these people will fit in very, very nicely on the servicing side. What we're going to ask them to do is really no different than what they've been doing. And it was a fairly easy adjust. You know, when you think about the companies in our industry and what we've adjusted to since March, on Thursday we were working from the office. On Tuesday of the following week, 98% of our company was working from home, and I think that's true of most of the industry.
Right.
If this had happened 10 years ago, there's no way we could have done all this. And all the things that we're facing, and that, you know, dealing with the CARES Act and having to support families and helping cover their mortgages with investors, and taking on that responsibility while helping those consumers that did have jobs to lower their monthly payments, which is really a big deal for so many. That really, you know, we got busy kind of at both ends at the same time. And fortunately, having these reinforcements come over the hill at just the right time was very, very positive news for our entire organization, where so many people have been working so much overtime and are really exhausted. To get that extra help arrive just in time. Nobody's fighting for turf wars or who's protecting which side of their job. Everybody's just glad to get the help. So I think we're really not having too much trouble fitting everybody in.
Yeah, the work from home or remote location conundrum is challenging, or it was in the first month is what I hear
I
from.
don't think so. I think it's proven to be the greatest opportunity of my career. This
Really?
is the first time I haven't had to worry about walls and ceilings and chairs and desks and parking spaces. I've spent so much time thinking about parking spaces, I can't even begin to explain to you how much time was added back to my career. And we're a mortgage company without boundaries. We are not limited by our constraints of space and physical being. What a wonderful way to be alive in our industry today. It's the
So-
greatest thing that ever happened.
So are you throwing out the bricks and mortar blueprint? Are you going to go to a hybrid model once this is all said and done?
Well, so I think, I don't have a dog or little kids, but I'm used to seeing dogs and little kids when I have meetings. And I'm used to hearing, we're adjusting to people's lives and we get to know them. I get to see your family in the screen. I think that I actually feel more tethered than I ever felt before with my staff. I meet with them every day for an hour, all the key employees all at once. I used to travel around the country so I could shake hands and buy a drink and take people to dinner. I haven't had to do that. So the opportunity to see all the key people that I do business with every day, to say, oh, you know what, hang on the line after this meeting. I want to visit with you for a couple of minutes with somebody that's in Jacksonville or in San Dimas or in Chicago or Dallas. It's just a wonderful thing. To have that opportunity and to be feeling so close, and I know it permeates our entire organization. I really feel good about it. That's a positive. That's that, and at the end of the day, are some people going to be more effective working from the office? Absolutely. Are some people going to be more effective working from home? We've proven that to be true. We've never seen such great volumes and such high performance, and the quality of the work's been great. I'm just delighted with the way that's worked out.
Good for you. Okay, let's shift and let's talk about innovation again. This time it's forced innovation. In 2020, with everything we're talking about, we're forced as an industry to do things differently, better, more efficient, right? Different ways of being interacting with our customers and with one another. We've seen in this last year accelerated adoption of digital mortgage and e-closings and even remote online notarization, except here in California. What further innovations do you think will create the greatest efficiencies for your team while also engaging them and allowing them to keep up with their monumental loan pipelines? So I'm talking about origination side now. The next question is going to be on the servicing, okay?
Well, I think they're both the same. So
Okay.
the ultimate accomplishment would be for you to think you want a mortgage and me to send you the money because I thought that you qualified because all your information became instantly available to me. 30 seconds went by and a screen popped up green. And you qualified, we sent you the money, and all of this happened instantaneously. That's the perfect dream. Now there's rules that stop that from happening. We have to follow regulations, so there's timing built in that's prohibitive to that. There's some, on the servicing side, there's things we have to do like trial mods and various paths to cure through loss mitigation that requires some interaction. But in the most perfect world, and I think you start with what you want, right? And you end up with what you can have, and then you try and go from there. And I think it starts by deciding the way it should be. And if you can buy a car in a couple of minutes for a couple of $100,000, why couldn't you buy a house for a couple of $100,000? The house isn't going anywhere. You know where the house is. It's easy to find, and you know what's in it. So it would seem to me that we should be able to do that more efficiently. In a perfect world, we'd be able to have the consumer decide what he wants, apply for a loan, fulfill the loan himself, push send, have the approval come back, and have the loan take place in several days or out whatever the law permits. And that's the way we want to do this. And I think that as an industry, we'll all arrive there around the same time. And ultimately that will happen. The problem that we face today, so we do that today with most of our government loans for refinance. That's one of the reasons that we're able to do that at such a high scale. But you can't do it with all products because certain products require additional underwriting, additional documentation that you can't verify automatically. So some products require more, and that goes back to that iterative nature, right? That
Yeah.
step after step, one piling up on the next, where everything we do grows into what we're going to do next. And I think that we see that happening. I think we invest a lot of money in technology. But what we're doing is we're looking at process and what we want. We go to the end and we figure out how can we make that work. And as a result, we've really changed the paradigm in things like underwriting, not so much in things like closing, in things like originations, but not so much in things like collecting documents from self-employed people. So there are some things that we're able to do really well and some things that we can't do quite as well. There's a lot of stuff that's not quite, the data is not quite readily available for us to take advantage of in order to make the process more perfect. And that's why it's hard to build a machine that suits everybody. And I think what you see is the companies that do the most volume have boxes that are smaller and then that grow over time rather than that are wide and try and fit everybody, because it's really hard to do this one size fits all. It's just not true. So you have to either have a specialty, and that's the way we've done this, is we've tried to specialize in a certain area and become really automated in that area. And we've had a lot of success with that. We're really good at that. But we're not as good if we had to do a jumbo loan and for self-employed people on 10 acres of ground, that's really hard for us. It takes a lot of time, it takes a lot of analysis, and it slows down our process and doesn't fit our machine quite as well. If we have credit exceptions or other types of things that don't translate as well into our current technology. So my hope would be both on the loss mitigation side and servicing and on the origination side is that the customer could self-serve, that he could produce all the documentation that we need. We could review it in an automated fashion, then have a human with the appropriate designations check the data that was completed and say it was done appropriately, and then move on to fund the loan. And that would be the way I'd like to see it done. And clearly we have to overcome all the issues of the documentation that's not as readily available or as easily verifiable. Because at the end of the day, we're lending my money. And I expect the number one rule is we want people to pay it back. It's our money. So, irrespective of where we may sell the loan to, we're responsible for it. So we're making the loan as if it's our money because in effect it is.
So the other element, and thank you for that, this is a very thoughtful answer. The other element to your business model is that you're dealing with government agency counterparties and loan programs backed by full faith and credit of the U.S. government.
Yeah, they probably won't fail.
Right. So they have their own, because these are government insured loans, government guaranteed. They have their own set of underwriting guidelines, servicing guidelines, QC, you name it. So putting on your mortgage banker owner hat, as well as your industry thought leader hat, if you were going to go to Congress today, what would be your ask? How can Ginnie Mae, FHA, HUD, VA help you in terms of their innovation strides to make you a better mortgage lender servicer?
So I don't think it's their responsibility to make me better. I think the only thing I would ask of our government is to keep helping the communities that we serve. The number one thing that I look to is the opportunity to help these underserved folks and the vets. These people need our help, and that liquidity is critical. And the most frightening thing to me is that we don't take care of our neighbors. If we're not doing the work to take care of the people that need that help the most, I think as a government, we would be failing. I'm not a socialist. I'm probably as far opposite of being a socialist as is possible. I'm clearly a capitalist, but I also believe that I have a responsibility, and I believe in capitalism with responsibility. So I'd like to consider myself a responsible capitalist who really understands the needs of those that we serve. Because if you don't care for those people that need it the most, they can't move up and won't have the opportunities to build wealth the way other segments of the population does. And the one underlying thing in our nation that makes us special is that we're a meritocracy that provides a level playing field to folks, giving them the opportunity to succeed. I know that my parents sacrificed for me to advance, and I've sacrificed for my children to advance. I think my parents' parents sacrificed for them to advance. And if I keep going back, I know that went on for a long time prior to that. And if you look through most of society, that's happened in a lot of different ways for an awful lot of people. And we've seen a lot of people rise from somewhat humble beginnings to be very great successes in our country. And I don't think you can do that everywhere in the world. And to have the opportunity to do that here, I think is what makes this country special. And I think part of that is the opportunity that government lending provides to vets and the underserved. And I really take that as a very serious responsibility.
Mm-hmm. Very good. We're going into an election, the 2020-2021 cycle. We may have a new president, we may not, but from a housing policy standpoint, again, combining your mortgage banker owner hat with your industry thought leader hat, what are the critical issues that you would like to see addressed either by our federal regulators, our states, and Congress in the coming, year to year cycle?
So my friends in all those places, I would be quick not to judge. And I would not ask very much of them. My job is to respond to the policies that exist in our country. I'm not a policymaker. I am not naive enough to believe that I can really influence policy dramatically. I think I need to understand policy, and I think I need to understand the way the table's set so I know where to sit. But I don't think it's my job to drive policy. I think my job is to make sure that as a government, they know that I'm an advocate for liquidity. And to have government-backed liquidity to have a 30-year mortgage, to have government-sponsored lending like the FHA and the VA that's
Yeah.
not dependent upon private insurance to succeed, where the consumer can buy a home with a small down payment and build wealth over time. I think they're big deal thoughts, and I'm more about the high level thoughts than I am about, well, I don't know if we should do it this way or we should do it that way. And I hear my peers often get dragged down into the muck a little bit of the detail around forming policy and having it stilted this way or stilted that way. I try not to do that because I think that there's a social contract there. I think there's a reality that our nation has to take care of, the folks that live in it. And I think we have a responsibility to that. So creating liquidity so people can own a home, so that we can do our job, which is fostering home ownership, having people use their greatest asset and help them leverage it, so that they can build wealth. I think that's my job. If the rules change or the playing field shifts left or right, that's just part of the deal. I have to accept that, and we have to build ourselves into being exemplary rule followers. Sometimes it's more challenging than others because sometimes what we view as the right thing to do is not the right thing for all stakeholders. And I think that it's a complicated mission. We have people that invest in MSRs like Freedom, and people that invest in MBS like REITs, and large investment firms and foreign entities, and they need to get returns on their securities, and they have to be reliable. We have consumers to worry about and help them get the lowest possible rates so that they can manage their day-to-day lives in the most reasonable fashion that they can. So they're three pretty conflicting stakeholders, and it's not my job to reconcile those three. So all I ever ask of the government is please clarify what it is you want us to focus on so we can follow the rules. As long as we get good, clear rules, we can follow them. It's hard to imagine what the rules are going to be at a different point in time. So that's why I try to stay active as part of that voice, so that we can ask for clear rules, so that we can follow the wishes of society. And our elected officials generally, voice the wishes of society. And our mission is to support those voices.
Right. Is your company involved in the Mortgage Action Alliance or any, other types of advocacy efforts in the state and local level?
We are, but on a limited basis. I've been very frustrated through the years at our ability to make a big difference there. I think it's important to hear your voice heard. I think it's important to share points of view and information, and I work really hard to do that, to share our points of view and our understanding of what we think is important. But I think it's a little difficult sometimes people become a little full of themselves and think that they can personally change a tide. And I don't think that's my role. So I like to stay informed, and I like to be able to carry out the rules that I'm responsible for, rather than try and shape policy and points of view. So I try and stay informed, and I try and encourage our team to stay active in all things that are advocacy oriented, because we should understand that. And then we work hard to make sure that if we think something is not right, to share that point of view.
Yes. Yes. I'm one that advocate for grassroots advocacy. being in a progressive state, the active state legislature that meets every year, almost all year, it's important for stakeholders to give feedback on policies and proposed bills, just to help legislatures and government do the right thing and serve
Hard
their
job, isn't it?
and we're boots on the ground. You know, we've got the real life experience to share with them, and so that they help them avoid pitfalls.
You have to do, right? So,
Yeah.
you know, one of the reasons that's so frustrating is you're talking to people that are sometimes more interested in sound bites than they are in learning about the issues and what the possible opportunities are. Because I really see there being opportunities in issues, not problems. And sometimes the really frustrating thing is some of these people that you might speak to that have a vote, when you don't, are not as interested in being educated, and they're following a doctrine rather than their own personal education. So I find that challenging to change. So I don't think it's the best use of my time.
Okay. All right. Now looking, to the far future. I'm talking again about, innovation in housing finance. What do you foresee as being trends or maybe elements that would surprise us in looking at your crystal ball? What trends do you see in the next decade?
Well, I think that's an interesting question. And what I think makes it interesting is more of the trends of the decade and the housing cycle rather than the innovation. I think innovation is going to happen because, like I said, we stand on the shoulders of those that came before us. All of the activities from an innovative side are going to continue to occur until there isn't any money to spend on them because we hit challenges economically. I think the more interesting question as the decade wears on, I think we're probably in the early innings of difficult economic times. I think that we'll see lower interest rates in the next year or so. I think we'll see the housing will attempt to lead us out of this recession. I think we'll see a lot of building. I know that there's a lot of action going on in that regard. There's a lot of builder optimism. I think we'll see housing increase in volume to meet the demand. I think we'll see a lot of people moving up and some people moving into home ownership. We're reversing a trend that has taken home ownership down for a little while, and I think you'll see that go back up. So I think the answer to your question is really not about innovation, but about managing the housing cycle over the next decade. And to me, I think that we have to make sure that we're measured. We're facing a period of time where property values will rise because I think those people that are employed is a large enough percentage to buy homes. I think we'll see some of the people that are employed make a little more money. And I think we'll still see some strain on unemployment. So we have low interest rates, rising property values, a building boom that's on the horizon. And ultimately, I think that leads us to a little frothy environment where the value of properties got too high. And as the refinance activity burns off and has been worked through for the next couple, 3 years, you'll see a widening of the credit funnel so that more people can fill all that housing that was created. I think we'll probably go too far because in my career, we always do. This part of the housing cycle has never failed to get frothy. And the two big times that I think about are really the late 80s and the Great Recession in at the turn of the decade, the 2000s into 2010. So I think we're facing some of that. And this one, like the recession of 2010, like the issues in the late 80s during the RTC emergence and the asset value depreciation, which was really essentially the same set of issues, right? Falling interest rates, rising property values, lack of inventory. Those things were all true in both of those instances. So I think the confluence of these forces as we get towards the end of the decade, 27, 28, I think that there'll be challenges. And I think it's important that instead of really opening the credit funnel, that as we move into the frothy period, that we tighten the credit funnel ahead of the correction. Manage LTVs as property values rise, and don't try and push everybody into a home that can't really afford it. Right. As much as I'm about supporting the underserved, we also only make loans to people that can pay us back. That's a rule. And I think it should be the rule for all lending. Otherwise, they should call it grants. So if we want to make grants as a society, I'm happy to help the government make grants to build home ownership, to build stronger communities. But if we make the loans to people that can't pay us back, we end up with zombie homes and vacant properties, and neighborhoods collapse, and the value of properties in those neighborhoods collapse. The living conditions around those properties get worse, and it's only bad things. And that's why when I talk about advocacy, I think it's important that we educate the legislatures and those people that do that advocacy, not just tell them our point of view. And I think that's where advocacy falls short. It doesn't do a good job of educating people to the dangers of the housing cycle. Rather, it deals in the moment. And anything that deals in the moment is bound to fail. That's why when you see businesses that are successful, and so many businesses, particularly in our industry, that failed during the cycle last time, a lot of them were businesses that went public and that had to live quarter to quarter to support their stock price, which is very challenging to do in a volatile marketplace over a long period of time. So, I think we have to be vigilant. We have to be sober. We have to be thoughtful. And we have to look at what's next, not what was last. And if there is a shortfall that we have as human beings, we have a tendency to look over our shoulder at what happened to us, not look in front of us as to what's going to happen to us.
So what I think I'm hearing is that you still believe in the American dream of home ownership, but that it should be tempered, that it's not for everybody, and that each family, each prospective homeowner needs to look at their objectives and their financial profile, and whether they want to take on the risk that as well as the benefit of home ownership. Yeah.
You have to live within your means. I think that's really the key. Yeah, as the lender, we want to lend to people that can pay us back. As a borrower, I think you should buy a little less house than you need so that you can pay it off, because I still believe the best mortgage is no mortgage.
Oh, you do? Okay. The mortgage interest deduction is one of the few available deductions for individuals and families.
But would you rather save $1 or the 50 cents in tax?
Mm-hmm.
So I think I'll pick the $1 every time.
Okay. All right. And the baby boomer generation, do you see any trends there? Are they gonna leave their home?
Die.
They're gonna
the way of the world.
Yeah, you know, that the housing they're contributing to the housing shortage by staying put.
Well, people are living longer, right? So that's
Right.
part of the deal.
That is part of the deal. Hey, we have a question from the audience, and it concerns the recent news of it. There's a number of mortgage bankers announcing that they're going to go public. And
I've heard that.
yes, um, and the audience members asking, are you and is Freedom thinking about going public as well?
Well, I'm pretty certain that Freedom's not going to go public. I believe that there's an opportunity for some people in some instances to take advantage of what's going to be a great return for investors over the next 3 years. So I think it depends on your investment horizon and on your personal situation. I think that going public is a great estate planning opportunity. Some people view it as an opportunity. For example, a lot of the mortgage companies that have gone public, the primary investor in those companies or owner of those companies were funds that have horizons. And it gives them a chance to restock their shelves and return some capital to their shareholders. I think it's a good fit in those instances. But for the new owners, the new public shareholders, for their investment to be a good investment, it requires good management. And some of these companies that are going public have outstanding management. I'm sure they'll try and do the right thing. The only question has to be, am I in a volatile marketplace, and am I behaving conservatively enough to not make short-term decisions at the expense of the long-term value? And I think all public companies in our country have that problem where they're managing the quarterly earnings and the short-term shareholder interests rather than the long-term health of their company. So that would be my concern there. I believe that the economics support being private just as well as being public. I don't think that you're going to get better economic returns over time by being public than you would by being private. There may be opportunities in any short period of time and places where it fits.
And for, you know, the college graduates, the younger generation who's thinking about a career in mortgage banking, what do you say?
Well, get your applications in. We need the help. We hire a whole bunch all the time because they're great, right? I like to hire people that are trained. I prefer people that have a little bit of experience just from a personal standpoint, because I don't want to teach them to be adults. That's the challenging part of hiring people right out of college. But I think people out of college, you know, and now that we've got some size in our company, they work hard. They're interested in building their careers. And as long as they're coming in and they're working hard and they want to learn, there are opportunities for you to really grow and learn a lot. There's nothing like the action that we're living through today to enhance your learning experience, because it's fast paced. There's lots of pressure. You're doing a lot of great things for consumers. There's a real high level of social consciousness. You know, we just at Freedom, we do all kinds of stuff for vets, homes for vets, backpacks for their kids. We donated $1 million to Feed America during the height of the COVID thing. So we've done a lot of things that really appeal to younger people, and they get to participate in that and make a difference. So to have the ability to make a difference on the social level and to make a difference in your personal career and serve your enlightened self-interest, even though you're not too sure what it is, and have a chance to find a place for yourself and develop your skill set, I think is a phenomenal thing.
Yes, and I should clarify my statement too, in that you don't have to have a college degree to go into the mortgage banking field. You have to, I firmly believe you have to have an entrepreneurial spirit to do
Well,
that.
for all jobs, there's skilled labor and semi-skilled and unskilled, and there's a place for all of those things to rise and thrive. And the ability to move from one to the next is probably better in mortgage banking than in other industries.
Yes. Yeah. There's even a place for former insurance industry annuity sales people and lawyers to have a passion masochistically for compliance and licensing. But yeah,
And you better honor that, because you're going to be out of business.
Okay, one more question from the audience, and we're running short on time. And this is on COVID and the forbearance CARES Act program. Are you getting sufficient guidance from the government on how to, now that you've got forbearance requests in, how to segue those borrowers through the forbearance period and into, bringing them current or putting them into other alternative vehicles like loan mods?
All right, I'm going to answer that, but in case we get rushed off at the end, I want to thank you. You did a great job. And
thank you. Thank you.
And Citus for supporting this and welcoming me in. You've been really great to me, and I appreciate that. So now let me answer your question.
All right, 3 minutes.
Okay, so I'll try and stick to that, or less if I can. So the forbearance was challenging because it showed up all at once really fast in an act of Congress without a lot of support from or input from the people that had to be stakeholders, government agencies, who are the investors in all our loans. So we didn't own the loans that we were servicing. We were servicing them for others. So we were servicing them based on the guidelines that were at our disposal at the time. So we had to follow the investor guidelines and conform to the CARE Act that the investor guidelines didn't necessarily support. Today, I think that the investor guidelines do support creating a so what we learned was, one, we put the people into forbearance and help them right away, solve their problem immediately, and give them a path to extend it as long as they need it. And I think that was really the intent of the CARES Act, and that's the way we interpret it. So we got people in, and we check on them regularly, and they have intervals where it rolls to continue, or they find a path to cure. Amazingly, like 30 or 40% of all those people never missed a payment, of the people that went into forbearance. And so many of them have cured. So not only has that leveled off, but we've seen a lot of cure. We still have over 20% of the people that are in forbearance making their payments every month, which is just an amazing thing to me. People that were given a hall pass essentially on their mortgage chose to make that payment anyway. It restored my faith in humanity. It was really a great thing to see. But I think even moreover than that, the path to cure for the consumer is really clear, and we can help them today. We know what to do and how to help them. The only problem we have is getting right person contact. So we're calling these folks proactively to share with them their path to cure, but they're afraid because we're a bill collector and they don't want to answer our call. So we have to work really hard to reach all these people. And if I ask the government agencies for one thing, is let them know we're trying to help them. We're not trying to collect their bills or throw them out. We really want to help these folks. The job that the government's done has been phenomenal to help these people.
Great.
And this is Dan Smith, and what an interesting and engaging discussion. And thank you both so much. And Stan, you talked about freedom. not having, boundaries now with the work from home expansion. The same holds true for webinars like this, and what a pleasure to bring this substantive conversation into our offices or home offices. So Melissa and Stan, very well done. Thank you again. And as a reminder, please join us on December 9 to see the MMC view with Jeremy Wyndham of expansions in the non-bank expansion era. Thank you so much, and take care, everyone.
Thank you.
Bye-bye.
Nancy's great, by the way.
Thanks and goodbye.
Thanks
Bye-bye.
again. Thanks.